All right, thanks everyone for holding. Today we're going to spend a few minutes talking about 8 mistakes money managers make and the power of process to fix those mistakes. If you have questions along the way, there's a chat dialog box inside of WebEx. You ask that and I will respond to the question as soon as I see it. So with that, let's kick off. So what's the problem? The problem is that 90% of fund managers don't have their 5 best ideas as their 5 largest positions. So how does a fund allow something like that to happen? Well, let's imagine that we have 2 cases. We have the case of the traditional portfolio manager. That's this person right here. And then we're going to do a more process-oriented position sizing. And first step is to allow the portfolio manager to define some rules for how this process-oriented position sizing is going to work. And then we're going to take the same set of research that a typical fundamental portfolio manager is going to employ when making position size decisions. They're going to care about expected return. They're going to have different attributes that don't necessarily go into the expected return that help them determine how confident they are in their idea. And those things are going to go into both the portfolio manager and the system. And out are going to come suggested position sizes. One went through the mental calculator of a portfolio manager, and the other one went through a process-oriented, rules-based methodology. We'll factor in confidence, and you can see that the confidence wasn't 100%, so the position size went down. There's paying some dividends, so the position size goes up a little bit slightly, but it's precise in the process-oriented methodology. Liquidity gets factored in, drawdown risk, sector exposure. And based on the rules that the portfolio manager set a priori, this should be a 1.4% position, but in their head, with their mental calculator, they came up with a 5% position. And so this is how things get out of whack. If we think about a portfolio that's constructed this way, one using heuristics and a portfolio manager's mental calculator and one using a process, we can quickly see how position size and idea quality get out of whack. And we can see in a process-oriented way how they stay in tune. And so this is how 90% of fund managers don't have their 5 best ideas as their 5 largest positions, because they don't have a repeatable process for how they approach position sizing. So I'm going to walk through 8 mistakes. We have a short amount of time on the phone together, so I will do it fairly quickly. We have time to follow up afterwards. My contact information is there, but let's dive in. First is going to be confidence bias, and you're going to see a recurring theme where one of the ways of fixing problems is by making things explicit. What we're going to be making explicit is what we believe we can make and what we believe we can lose, with probabilities associated with them. In this example, I'm going to talk about confidence bias, and this is something that I've run across multiple times. I'll give a specific example. When I was working with a portfolio manager, getting them to describe how they determined that this position, whatever it was, should be their largest position. And basically what they described to me was that this is a name that I know really well. I know the management team. I've been in this name for a long time, and I know they're going to beat earnings. And I said to them, okay, that's great. If they do beat earnings, what do you think the upside is? I said, probably 15%. It's like, okay, well, what's the probability of them beating? I said, I'm almost positive. Let's say 90%. It's like, okay. And what happens if they miss? He said, actually, that wouldn't be too good because everyone knows they're going to beat. It's like, okay, how much? I said, stock would be down at least 30%. It's like, perfect. So let's just make that explicit and calculate an expected return. With that information, we calculated that it was an 11% expected return, which he then compared to other potential returns in his portfolio and said, you know what, this probably shouldn't be the largest position in my portfolio. Well, the information really didn't change. How it was presented was changed. The process around it changed. And by allowing a portfolio manager to reflect on things in explicit terms instead of implicit terms, that's the mental calculation versus the process-oriented calculation, you can quickly see how the confidence bias impacted position size inappropriately. And so with that, we'll move on to mistake number 2. This is very similar in the sense that we are going to use calculating upsides, downsides with probabilities to help fix a problem. In this case, let's understand what happens for the compounding effect from a portfolio's returns. Let's say that we have $1 billion return, $1 billion fund, and that $1 billion fund goes up 50% in year 1 and down 50% in year 2. Do we, after those 2 years, still have a $1 billion fund? The answer is no. Our $1 billion fund has turned into a $750 million fund. The reason is because upside and downside are not created equivalently. And so this goes along to Warren Buffett's adage, rule number 1, never lose money. Rule number 2, never forget rule number 1. And we've done some empirical research highlighting the impacts of making sure that you're coming up with price targets. From our research, we found that positions with price targets have an average return on invested capital of about 7.5%. When a fund doesn't take the time to come up with price targets, the return on invested capital is 0.7. A huge gap between taking the time to come up with the fundamental research used to drive both the getting over things like confidence bias and then calculating downside in mistake number 2. Okay, mistake number 3. It's what we call the good stock paradox. And to do this, I will walk through an example. Let's say that we have a $20 stock. We believe there's upside to 50, we have a downside of 10, and we have 75% probability of upside and a 25% probability of downside. Do the math for you. That's a $40 expected return. Current price is 20. That means it's a 100% probability weighted return. And let's say that we have a 3% position. Let's say the stock does exactly what we want it to do. It goes from 20 to 40. What's happened to the position size? It's doubled. What's happened to the expected return? It's gone to 0. Stock went to 40. We were expecting it to go to 40. This is the good stock paradox. As expected return or probability weighted return goes down, so does the position size goes in the opposite direction. And so let's assume that as the price went up, our estimation of upside and downside had changed. But even if we change those assumptions, we still may not be able to justify the much larger position than what we had originally. So the good stock paradox is just the understanding that expected return and position size go in opposite directions, and by creating explicit procedures, by calculating expected return that's dynamic as price changes and putting that right beside the position size that we have in our portfolio, we can quickly highlight where there's discrepancies caused by the good stock paradox. All right, mistake number 4. Volatility is not risk. I'm not saying it's not a component of risk. It's just not, you can't substitute the word volatility and risk. And I'll give you an example. So let's say that we have 2 stocks. They're both trading at $20. One has an annualized vol of 40. One has an annualized vol of 20. So the implied downside using volatility for asset number 1 is $12. And for asset number 2, it's $16. Just looking at this, just looking at volatility, you would say that asset number 1 is the riskier of the 2. But what if I gave you more information and said that net cash per share of asset number 1 is $16 a share, and for asset number 2, it's $12 a share? The higher vol stock has more downside fundamental protection from its balance sheet than asset number 2. Which one would you say is riskier in this case? I would argue that the asset that has more net cash per share protection is less risky, even though it has higher volatility. So let's understand that risk is a compilation of multiple factors. Volatility certainly can be one of them, but I would argue for fundamental investors that downside risk is a much more important component, and when a process-oriented position sizing approach is applied, then the downside risk is calculated for every position in the portfolio. Mistake number 5, position overload. So what we have here is one of the most common things that I found when working with managers is they end up having too many positions in their portfolio. And I'm going to walk through a few different reasons why this is deleterious to returns. And so I think probably the most obvious is what we call mental capital math. And it's based on the fact that as human beings, we have a limited number of hours and a limited capacity to understand multiple things. And so what we're trying to do is to say that there's a number of hours that you can allocate each year to investing. Let's say that it's 2,000. And let's say that we break our portfolio into 2 components. The active portfolio, those are the positions that we currently hold, and then ideas that we are working on and considering putting into the portfolio. Let's say that we allocate 40% of our time to working on ideas. That leaves 60% of our time to active positions, or 120 hours. And let's say that on average, we need 75 hours a year to analyze a position. And so what that means, if that is the case, then the number of active positions that one analyst can evaluate is about 16. And if for each fund, these numbers could be different. You'll have to do your own math. But I think this is a really good tool to apply and figure out what's the right mix of names for me to be evaluating both in the portfolio and as ideas, and how many names in the portfolio can I actively manage and do an effective job. So I think mental capital math is a good way of measuring what's appropriate for your fund. But let's highlight some empirical evidence that we found that point out that position overload is deleterious to returns. And so what we've done is we measured the batting average, that is how many winners you have in your portfolio. Winner is defined as something that makes you money, divided by the total number of positions. And what we did is we took our clients' portfolios and we segmented them into buckets, and we said we take the top 5, top 10, 6 through 15, 11 through 20, and you can see the rankings as we go down, and bucketed them. And we did that position rank by position size. So their biggest positions, their second largest set of positions, their third largest set of positions. And what we found is that the largest positions outperformed on a batting average basis. They were more likely to be winners than not. Then the second bucket, then the third bucket, then the fourth bucket, go down and down and down until we get into randomness somewhere around 20 or 30 stocks. And so what this highlights is that there's a decay as we go down in the portfolio towards smaller position sizes to a point where we get to randomness. And these positions end up being drags on the portfolio, not just drags from a performance standpoint, they also are drags from a mental capital standpoint. And if we could just cut the portfolio to focus on the largest positions, or the positions where we have the most confidence and the ones that we've done the most research, or the ones that have the best expected returns, we could create far superior portfolios. All right, the last point I'll make on position overload is that one way to think of it is that there's a universe of potential investments out there. And because the market is largely efficient, the range of positions that fall into what we call this no invest zone, that means the expected return that you can get from them is not great enough. I've put it at bands of negative 15% to positive 15%. Anything outside of that is a place where you can find arbitrage or something to invest in, and anything in between is that very big swath of the market that isn't investable. And so you have to turn over a lot of stones before you can find something out of this zone. I think this is a good mental framework to understand the landscape that we deal with, and know that you're going to have to look at many, many names to find one good one. So mistake number 5, position overload. We'll transition into mistake number 6. What we find with a lot of our managers is that when they're trying to hedge their book, they put on ETF hedges. And ETF hedge is much like insurance. We know that insurance has a negative expected payout. We know that it has a negative expected return. But I think it's important, if as investors, to take the time to think about the negative impacts that ETF hedge has on our portfolio. Make sure that it's giving us the appropriate impact that we would want. And so what we would do is just say that we have a portfolio that has no hedge. Currently has an expected return of 14%. It has net exposure of 34% and gross exposure of 34%. I'm currently getting 41 basis points of return for each percentage point of gross exposure. Well, let's say that I put on an ETF hedge because I want to get down to 20% net exposure. I do that, and I've increased my gross exposure from 34% to 48%, while decreasing my portfolio expected return from 14 to 12. Why did it decrease? Because the ETF hedge has a negative expected return. If it doesn't have a negative expected return, then it's an idiosyncratic bet that could actually be contributory to the portfolio. But most hedges, when penciled out, have negative expected returns. And so another option would be potentially just to cut some exposure out of this portfolio to get you down to a net exposure of 34%. And let's say that we cut the weakest names from an expected return standpoint out of our portfolio. That would drop our overall portfolio expected return to 10%, but we dropped our gross exposure also to 20%. And from a return on invested capital basis, we're getting more return per unit of exposure. We could do it instead of just trimming the weakest expected returns. We could have just made pro rata cuts, just cut every single position size by a pro rata amount. It would drop our portfolio expected return to 8%, but we'd still get 41 basis points of return for a smaller gross exposure. Now, it's going to be dependent upon what kind of portfolio you're trying to construct, if leverage is free, and what your investors are looking for. But just understanding that there are different options, and those different options have different payout structures, is very important. And only way to actually make sure that you're doing that appropriately is to actually calculate what's the expected return of my hedge that I am putting into my portfolio. It is not costless. Okay, mistake number 7, value trap. And let's just take a hypothetical position and say that it's a $9 stock that has $8.50 in net cash. That just starting out sounds fantastic because there's such limited downside in this position that you want to put this in your portfolio. But it's really important. This is kind of the opposite of not calculating downside risk. This is not calculating what's my potential return, because you are allocating capital to this investment. Let's understand what your return profile looks like. And the only way to do that is to go beyond just saying, hey, I only have a limited downside. Let's talk about what I can make. Let's say that this stock's throwing off 10 cents a share and you apply a 15 multiple, you get an upside target of $10. And even if you assume a 90% chance of hitting that, it's still only a 9% expected return. I'm not saying that's a bad return and it shouldn't be in your portfolio. I just think it's really important to make sure that we understand the return profile of every investment we put in our portfolio and make sure that it's sized appropriately. When going through this kind of construct, you're going to point out these value traps and make sure that you're having the right conversations. All right, last mistake. We talked about this up front. Best ideas not being the largest position. You have to have process in place to make sure that idea quality and position size match up. How does it happen today? Just imagine all of the positions in a portfolio that are mentally calculated. Prices are constantly changing, fundamentals are constantly changing, position sizes are constantly changing, and we're asking portfolio managers in real time to make sure that position size and idea quality line up correctly. Well, now that we've created a construct to come up with suggested position size, we can do that in real time. We can make sure that our best ideas are our biggest positions. We can make sure that our weakest ideas are being culled from the portfolio, and we can size appropriately. And this matters because we destroy portfolio expected return by not sizing things optimally. So let's just imagine we have a hypothetical portfolio with, let's say, 35% of expected return, and we've sized everything perfectly. Our best idea is our biggest position, our 10th best idea is our 10th largest position. Let's just say that we make one mistake. Each of these positions are off by one position. My 5th best is my 6th largest, my 6th best is my 5th largest. Just that little shift cost us 50 basis points for a $100 million fund. That's $500,000. But that's not most funds. Most have more. Let's say we're 2 off. Cost us 1.1% of portfolio return. Let's say we're 5 off, 4.1%. Let's say that we're max off. We destroyed 15% of portfolio return, or $15 million on a $100 million portfolio, just by inefficiently sizing positions. And we also don't get the benefit of capitalizing on the random walk. What happens for a typical portfolio? Say we own a stock at 30, and let's say it's a 3% position size. Stock goes from 30 to 33. This is an example of the good stock paradox. Stock goes up. What's happened to our expected return? It's gone down from 26 to 15. What happened to our position size? It went up from 3 to 33. So we've increased our exposure to something with a lower expected return. Stock goes down to 27, hold the same amount. Stock goes back to 30. For that round trip, the average fund that doesn't trim around positions or capitalize in the random walk, the total return is 0, of course. Stock begins at 30, ends at 30, and I hold the same number of shares. Well, let's talk about if we're process-oriented. And stock goes from 30 to 33. We have the same number of shares at the beginning. Stock goes from 30 to 33. We trim the position because the expected return went down. Stock goes from 33 to 27. We increase the position. Stock goes back to 30. We own the same number of shares at the beginning and the end as the previous firm, but we've created 50 basis points of additional alpha net of 3-cent commission. There's so many of these positions in the average portfolio that it's a huge contributor to overall returns. So with that, I can open up to any questions, but overall conclusions, there are a multitude of mistakes that portfolio managers make. What we did through this presentation was just highlight a few that are common, but also fairly simple to fix. I'm not saying they're easy because there's human behavior that's involved with making these kinds of changes, but the fix is fairly simple. It requires taking the time to be thoughtful about what the expectations are for each investment in the portfolio and tying that to position size. And once that's done, conversations change and the portfolio is a better reflection of the fundamental research. If you have other questions, you can contact me with my contact information down below. Yeah, we have a question on volatility. Go back. Yeah, so what I was saying is that the implied downside for volatility, it's calculated as it's based on the vol of the assets. You could say, I should probably say that it's the volatility implied downside. And it's just basically saying that the downside is 1 standard deviation of volatility on the downside gets us to 12. 1 standard deviation of volatility for asset number 2 gets me down to 16. And the point being is that we have 2 measures of downside, one volatility-based, one net cash based, which one is more important to you as a fundamental manager? And I would argue that this asset, even though it has higher volatility, is less risky. Another question on so as we went through all these mistakes, we were fixing all the problems with using expected return or probability weighted return. And on the first slide, we had a bunch of other things. Yeah, I think that it is, all of these other things. Yeah, when we think about process-oriented position sizing, process-based position sizing, what we're talking about is that first step is coming up with the expected return, of course. But then we have to understand the other components that go into position size. And we're not saying that expected return alone determines position size. It's a combination. And for each firm, it's going to be different. But just understanding what the rules are for your firm, making sure that they're explicit, creating some business logic around them so that you can translate all of that information from your research process into a suggested position size, and have that suggested position size lined up to your current position size. And where there's big discrepancies, have good conversations. Okay. With that, like I said, if you have any other questions, you can contact me at the email address, if I can finally scroll through all these slides, at the email address here below, or you can contact us through the website. And thanks so much for the time today.